On the residential side, I think those valuations are only going to continue getting stronger. I think interest rates will probably stabilize and or come down over the next 2 years. And so I think a lot of people who are sitting on residential, they'll still be able to get the prices that they want on things just because the buyer pool is so hungry, hungry for the inventory that is there.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming back Anthony Vicino for the second time. He's a best-selling author, host of the Multifamily Investing Made Simple podcast, has a great YouTube channel, and is also, I think you manage about $70 million of real estate. So, Anthony, thanks for coming back on the podcast.
Yeah, thanks for having me back. It's good to be here.
No problem. Yeah, and I'm really looking forward to talking. And it's something that we were just talking about then that there's lots of concern in the property markets about the prices. I guess if we look at the past 10 years, massive bull run, many sort of cities have gone up exponentially. But we've seen interest rates increasing, sort of monetary policy tightening, and there's concern in the US and other countries as well that this can have a big impact on the value of homes and other real estate. So, do you have a hypothesis or thought on what we're currently seeing, and I guess what this will mean for properties this year or even the next few years?
Well, it's really interesting. So like our lens that we operate within is multifamily commercial real estate. So that's where most of my experience is. But for a lot of the listeners who maybe are looking at it more holistically, not just that one subset, they're maybe also looking at residential, because I think that's a huge subsection and it drives a lot of what everybody's experience of real estate is. I think on the residential side, one of the really interesting things that's happening, despite interest rates going up, is because there's such a constraint on supply. Like we already in the US were so supply constrained that we were going to have to be building, millions of additional units just to get caught up and meet the current demand. Well, that's definitely not happening right now with development kind of slowing down due to interest rates. Like a lot of developers are like, well, if we have a project in the works, we'll keep running with it, but it doesn't make sense to break ground right now, given what they're seeing with the unknowns. And it can be really hard actually to get the bank financing, even to get those projects started, even if they wanted to. So we're seeing even more tightening of supply. So as interest rates are rising, you would think, well, people are going to pay less for these buildings because now their money is not going as far. Well, what's happening because it is so supply constrained is that people are still willing to pay the high valuations, which is fascinating. Like my girlfriend and I, we anecdotally just sold our single family residence that we had lived in for the last 5, 6, 7 years. And it went for 35,000 over asking. So significantly more than what we thought it was going to go for, more than what we thought it would even appraise for. And people are still willing to pay these numbers. And the reason is they need a place to live. They want to have that house, and interest rates be damned. They got to pay what they got to pay because it is so supply constrained. So we're seeing this weird dynamic where valuations, despite transaction volume dropping, valuations are still remaining strong in most markets. Now, how long that lasts, hard to say, because we have this interesting situation where over the last 6 years, people were able to lock down ridiculously low interest rates. For us, like we had like a 2% mortgage, right? And so at that rate, you're very much incentivized just to not sell ever. And I think we're going to see a lot of people who, in 5, 6, 7 years, when they would otherwise want to sell their building, they're going to be like, well, I have such low debt on this thing that I might as well just hold it. And they might become inadvertent landlords as a consequence. And all that's going to just combine to constrict the supply even more. So one, it's a crappy situation for if you're young, if you're starting a family and you're trying to get into a starter house. And it's like, that's very difficult right now. Very, very hard. And what we're seeing in terms of competitiveness is like, for us in our market, which isn't even the sexiest market, we live in the Twin Cities, right? Like Minneapolis, St. Paul, Minnesota. Even in our market, we're getting 25 offers within 24 hours. It's ridiculous. Like the time on market up here is less than 20 days, which is just absolutely ridiculous. Now you go to multifamily, we just step out of residential, we go into the commercial space. And it's a little bit different in the sense that, office, retail, those are their own bugaboos. But multifamily apartments, they've been historically so strong for the last 20, 30 years. Even during 2007, 8, we had still really strong underlying fundamentals and they performed well as a result. What's happening now is there is a discrepancy between what buyers are willing to pay and what sellers are willing to sell at. And a lot of this is good because buyers should not be going out there and paying these ridiculous multiples at the moment, given where interest rates are. So the banks are kind of coming in and imposing a little bit of a limitation based off of their DSCR, debt service coverage ratio requirements, right? So that's a good thing. The bad thing is you have these sellers who, they're going to be sitting on the sidelines if they can, but there's a lot of sellers. I was speaking at a conference last month where I spoke to a lot of investors, a lot of other operators, and there is a massive amount of capital calls and pending foreclosures. We've seen this on like $230 million portfolio down in Houston just like a month ago. We saw this with the largest landlord in San Francisco about 2 months ago, and that was office space, not multifamily. But we're seeing this over and over. And one of the underlying issues is people in the last 2-3 years were taking variable rate mortgages, which boggles my mind. Like still to this moment, like a lot of people are being caught with their pants down because now, when you locked in at 3%, now the interest rates are 6 and 7%, that has a massive ramification on your cash flows. I'm boggled that so many people in the last 2 years opted for variable rates when we were already at historical low interest rates. You had to know that they were only ever going to go one direction. You can make the argument, well, we didn't know the Fed was going to hike that quickly. We didn't know it was going to get that crazy. But still, like, you knew that they could only go one direction. Like if you were going to go get variable rate mortgage now at 6-7%, chances are good it's not going to go much higher. So you're probably pretty safe. Chances are it could come down over the next few years. So that might not be a bad gamble. But when you're sitting at 3% and all of a sudden it goes to 6%, like that's a doubling. That's murdering your cash flow right there. And a lot of operators are being caught woefully unprepared as a result. And we're already seeing a lot of capital calls or deals that are just going to fail entirely. So it's crazy times for sure.
Yeah, it's interesting. I guess if you look at the US, I think single family homes, it's quite unique because, as you said, there's lots of sort of fixed sort of mortgages. Whereas you compare it to Canada, UK, Australia, they're the ones that have the variables. So there's potentially more concern in those countries that once they shift, I think I was talking to someone and they said their friend repayments was going from 1,500 to 4,500,
Yeah.
a month, which is crazy to think. So I feel like, in terms of the US, and I guess the average home, they're probably protected. And as you said, people aren't going to sell them because the mortgage is going to be a lot higher. So there's going to be the scarcity, which would be very interesting.
Yeah, it's crazy. You think about, 2 years ago, you could have bought, let's say in the US, a $500,000 house at like 3% interest rate, right? Well, now you could at 6%, you can only afford a house for 250,000. So just bam, right there, like your buying power is just have, and if you're not in a situation where you need to go buy a house for whatever reason, like you're going to be fine. But it's a crazy disparity, especially on the multifamily commercial side, where if there's any kind of passive investment inside of that, like you had a fund or you were syndicating these assets and you have fiduciary responsibility to your investors, like a lot of people are just not going to be able to make the distributions that they were projecting. And it's good in the sense, I think this type of turmoil is good because it creates a lot of opportunity for people who are operating well. But I think it's also bad in the sense that where private placements in the commercial real estate space was like kind of a niche unknown thing over the last 30 years, it started to gain more prevalence in the last decade. And I think that was really good because I think private investors having access to these investment vehicles is a good thing. However, because there was more access, a lot of people could get into them much more easily, even if they weren't well prepared to weather the storm, so to speak. And so a lot of people are going to lose money is the end of the story there, which is always a bummer. But I mean, that's how these kind of great financial resets occur.
Yeah, definitely. So I guess from what I'm hearing, you're saying that single family home, especially in the US, you think they're going to continue to go up, even with mortgages at sort of record highs, and then multifamily, they're potentially going to decrease due to some of these foreclosures. There's going to be opportunities for investors, and I guess you think of the big players like BlackRock, and I'm sure they're going to come in and sweep up quite a lot as well.
Yeah, exactly. On the commercial multifamily side, the buyers aren't, if you're not forced to buy, right? Like nobody has a gun to your head saying you have to buy unless you have a fund that's running due and you're making some dubious decisions just so you can get that money, placed. But for the most part, you're never forced to buy. And so if you're patient, if you're diligent, you can find some really good opportunities here in the near future as, the mortgages, the terms on a commercial loan are just so much different than a residential, right? Where residential, you're getting a 30-year amortizing loan. And so people can hold on to that for a long time. Whereas in the commercial space, people might be getting 3 to 5 years on a bridge loan, right? That's not a lot of time. If you bought in 2021, suddenly you're looking down the barrel saying next year we need to get out of this asset somehow. And you might not be able to get out at the numbers that you thought you were going to. So I think on that side, there's going to be more buying opportunities. And the people who are able to not sell, who have a business plan that says, hey, you know what, we're just going to buy and hold. We have ample reserves. We have strong cash flow. We're just going to hold this for the next 5 years. They're probably going to do very, very well. It's the people who are going to find themselves having to sell this year, sell next year, maybe even the year after. Like having to sell is never the right situation. But on the residential side, I think those valuations are only going to continue getting stronger. I think interest rates will probably stabilize and or come down over the next 2 years. And so I think a lot of people who are sitting on residential, they'll still be able to get the prices that they want on things just because the buyer pool is so hungry, hungry for the inventory that is there.
Yeah, it's scary to think, I guess, for yeah, as you said, for young people to try to get on the
Yeah.
property ladder. So,
Good
so
luck.
from what you're hearing, everyone's saying doom gloom, property market's going to crash. You don't think so?
I don't know. Like it may crash. It may crash. I'm not sure what the underlying mechanism would be behind the crash, though, on residential side, right? Like I don't quite understand what's the weakness in the system that would lead to that kind of catastrophic systemic failure. I can understand it on the larger scale commercial, but on the small residential side, I don't quite see it yet.
Yeah, I guess you needed sort of a massive unemployment event or something like that, where people actually were forced out of their homes and they couldn't
Mhm.
repay their even low interest rate mortgages, which seems
Yeah,
very unlikely.
which seems unlikely because you look at the job market economically, it's if anything, it's too low, right? Like I don't know about most markets. I tend to pay attention very closely to what's happening in ours, and in Minneapolis, St. Paul, like we've had some of the lowest unemployment in the country. I think we're in the bottom three, so we're sub 3% for the last 4 years. And I can tell you, as like an employer, that we probably have like across all our businesses, maybe 50 or 60 employees. It's hard to hire. Like I don't. You would have there would have to be some massive unemployment events to shift those numbers meaningfully to the point where we would see a systemic issue. So I'd be really surprised on that side because the job market is still just very, very strong for the most part. And you could say like, well, what about in tech? Like there were so many layoffs and so much happening there. It's like, yeah, but a lot of those companies were just bloated, right? Like, and so that's one of the great things about running a tech software company is like you, when you want to, you just cut overhead and suddenly you've just increased your margins. Like everything is ticking along. You just don't grow as quickly anymore. So I don't see it. I don't see a path to it yet, but I could also be very, very wrong.
Yeah, exactly. It's but as you said, it's hard to see how that would occur. I know during COVID and I guess the last 2 years, there's been sort of this, another rhetoric about people moving out from the cities. They're sort of moving, suburbia. They're maybe even moving further because a lot of the jobs have been virtual. Do you think that's something, that was a trend that maybe occurred last year, but from what you're saying, it seems like that's almost reversing and people wanting to come back into the city and continue with that.
Yeah, I can only really speak from the perspective of our market. What we saw in 2020, 2021 was a mass exodus from downtown urban to the suburbs. And part of that in our market was exacerbated by the fact that like we were ground zero for the civil unrest, we'll say. And so there was other compounding factors in our market that led people to say, I don't want to be down here right now. And then in the last year or two, we've seen a resurgence, people coming back. And so I think the theory of like, oh, everybody's going to move out to the suburbs, that's great in theory, especially during like a lockdown world where people want to have more space. They want to, be able to go out in their yard and like enjoy that rather than just having a 1 bedroom, 2 bedroom apartment. But again, the reason that people choose to typically live in the metro is the access to opportunities, to nightlife, to recreation, to all the things that come with that. And so I think a lot of people who could move out to the suburbs, they did it because they were financially mobile. And they're like, I'm going to make the decision that allows me the most life satisfaction. And at that time, it was, I want to have more space. that's not really entering, I think, as much into the mental calculus anymore, as people aren't locked down. And so now they're saying, okay, where am I going to get the most enjoyment from my time and my money and my life? And that leads them back into the metro in a lot of cases. So I think I don't see a fundamental shift, at least in the US, of cultural norms that would lead the majority of people to want to leave the metro areas and go out into the urban, or I'm sorry, into the rural. And who knows, I could be completely wrong on that again, but all that's to say is I think that the really sweet spot is first ring suburbs around large metros. So if it's touching and it's like within a 5-15 minute drive of downtown areas, I think those suburban areas do really, really well, just because they kind of offered this nice blend of both worlds. But in terms of people just going pure rural and being more than 45 minutes outside of a major metro, I think all the things that lead to that being problematic are still there. And so you'll have people that choose that, but I think, again, most people won't.
When you look at an opportunity, I know it's going to be very broad and there's going to be lots of things that you're sort of analyzing, but what are the key things that you're really looking for? And then I guess any red flags that if you see, then you sort of want to try and avoid.
Yeah, so we spent a good chunk of time there talking about interest rates, so we might as well start with bank terms and debt terms, because um truthfully, the thing that I'm least interested in when it comes to buying a building and putting debt on it is the interest. Like, for how much that part of the conversation has dominated our attention in recent months and maybe the last year, like it's not the most important part to me, because the interest rate ultimately affects your cash flow, right? And that's important. However, it's if you have strong enough cash flow, the interest rate's never going to be the thing that forces you into selling, right? So number one, we go and we're looking for something that's cash flowing strongly enough from the beginning. And then when we're looking at bank terms, we're not really trying to nickel and dime and get the lowest interest rate. What we're really looking at are the things that are going to give us the most optionality when it comes to executing the business plan and potentially exiting. And so the things that affect optionality tend to be things like your debt term. How long is it, right? If I have 10 years to find the perfect moment to sell this asset rather than only 3 years, then chances are I'm going to have more likelihood of finding the right moment to profitably exit. If I have low prepayment penalties, then that also affects my ability to get in and out of the asset profitably. So if I have low prepayment penalties, then maybe in year 3, that actually is the right moment to sell. And now I can do it because I'm not going to get tagged with that big prepayment. If I have long interest only periods, then again, that's going to positively impact my cash flow, right? So I can maybe have a higher interest rate, but if I have 5 years of interest only and a 10-year debt term, well, I'm going to be sitting pretty for those first 5 years, and then we'll have to figure out what happens for years 5 to 10. But as long as I have optionality to look at the landscape, see what's coming down the pipeline, and then adjust accordingly, rather than having really narrow timelines because I have a 3-year term with adjustable rate mortgage because I'm taking bridge and like everything has to fall perfectly into place to profitably exit this thing. Like, that gives me nightmares just to think about it. And it's funny because if you're listening to this and you hear me say that, you're like, well, yeah, why would anybody do that? Well, here's the thing is, like, a lot of people did that. And that's the exact situation that we're finding ourselves in now with a lot of operators doing capital calls. Is like they did 3-year terms 2 years ago with adjustable rate mortgages. And it's like just staring down the barrel of a shotgun at this point. So that's what we look for from the bank terms. Look for optionality, things that give us a lot of choices. From the asset perspective, we're looking for things that are built like tanks that we want to own, not just for 5 years, but potentially for 15. Because again, optionality. If we find the right moment to sell in year 5 and we want to exit and dispose of this asset, awesome. But if we want to hold on to it even longer, we want to know that this building is going to last. And so we look for things that are built really well. And then we find fantastic neighborhoods that we think within a 15-year window are going to be highly desirable still. Because if you have a great asset in a great location, and you have the ability to pick your moment when you want to sell, it's really, really hard to get screwed over in this game. But if you have a questionable asset, even if it's in a great neighborhood, but you don't have a lot of time to do it, like to find the right buyer or the right scenario to exit, then you're going to be caught with your pants down potentially. So those are some things that we look for. In terms of the asset itself, we're looking for things that we can go in there and profitably operate from day one. Doesn't mean that we're going to be profitably operating and making tons of money from day one, but we want to know that there's enough cash flow from the very beginning to create a healthy buffer between our operating expenses and the ability to put money into our pocket. And then we're going to go into these assets, we're going to improve them so that we can, make them more profitable. We do that by increasing revenue, making the buildings more desirable for residents, and then decreasing expenses. And we do that over a 2 to 3 year window. And if we have that ability to go in there and drastically improve the assets and increase the profitability over the first 3 years, then we're looking at that and thinking, okay, this is probably something worth doing, because we never want to buy something where our only game plan is just betting on the market getting better, right? Like that's a surefire way to lose money.
Yeah, so that was quite interesting. You're talking about sort of like the I guess the bank terms, and then a lot of the times people are focusing on like what's the cheapest option, but that's really not the key thing that you should be focusing, I guess, in terms of maybe investing in these assets as well. You're not just looking for, as you said, it might be in a good neighborhood, but the cheapest thing on the street. You're also looking for those sort of buildings that do have value. As you said, built like a tank, and then you can upgrade and potentially increase it even further.
Yeah, we used to buy the worst buildings on the block, and we did the last building we did this with was in 2020 January. So right before the world ended with COVID and lockdowns. And what we discovered there was, even if you have the worst building on the best street, and you have this business plan that requires you to go in there and do all the renovations and then re-tenant it, well, you can still have a lot of issues in the meantime, right? Like COVID happened, suddenly you can't evict the terrible tenants that need to go. You can't do the renovations because supply chains are all backed up, and you can't get a refrigerator to save your life, right? And this is why I think a lot of developers are right now looking at putting a hold on projects, or not breaking ground, because there's so many unknown variables. And so what we decided was, okay, well, when you have the worst building on the street, like, you can get it up to market and do well. However, it usually requires a lot more risk in the beginning, a lot more work to get it fully operational and functional. So we'd rather something that's already performing pretty well, so kind of middle of the pack on the block, that we can go in, live off of that cash flow in the beginning, while we're also doing incremental improvements over a 3 year window, rather than just squishing it all into like a 6 month or 1 year window. We take a longer time horizon with it. And we know, okay, if we can just do this incrementally over the next couple of years, it's cash flowing in the meantime, so it's performing well. And then at the end, it's going to do very, very well. So we take a very long view, very patient. As a result, we don't generate as incredible of returns as you could. But in our game, what served us really well is to take care of the downside and let the upside take care of itself. And the way that you take care of the downside is just to give yourself really long, almost luxurious amounts of time to execute the game plan.
Yeah, as you said, it's literally minimizing as much downside as possible. So removing as much risk as you can and trying to maximize the upside. So getting that asymmetric sort of investment that you're looking for.
Mm-hmm. Yep, exactly.
Yeah, which is crazy to think. So, you've mentioned it before that you've sort of been on a really crazy journey. I think it's one of your YouTube videos where you're saying that you're in 80K in debt. You're really struggling. I think we talked about this last time as well.
Yeah.
And then in 3 years, you sort of became a millionaire. So I'm not sure if you want to go over that journey as well. And I guess what were the key things that you did to sort of transition between the first person to almost this second person?
Yeah, I mean, that was about a decade ago, and it's been 11 years. It's crazy. It's crazy to think. Like, when I was in my late 20s, life was not going good in terms of the direction that I was on and where I was at that moment. And what's been really interesting is, talking to young people who, like, air quotes, in like their late 20s, who are like, oh, I feel so far behind the curve, and like everybody's getting so far ahead of me. Or talking to people who are like in their early 20s. There's so many people that just feel like they're falling behind. And I think if there's anything in my story that maybe can give people a little bit of like confidence or hope, is that, I really didn't get my act together until I was 30. And once you do get your stuff together, like, things can start to snowball into the right direction for relatively quickly. For me, a lot had to happen to get to that place. Like, the soundbite is, oh, went from 80K to a millionaire in 3 years. But that's just the soundbite, right? Like, that it doesn't give you the full breadth of the story of like what was actually happening on a day-to-day basis. For me, a lot of that was luck. Like, totally transparently was the fact that I got into a business that had really low startup costs, really potentially high margins, and the growth was only dictated by how hard we were willing to work. And so I got really lucky that like skill as an entrepreneur wasn't really the variable of success. And for people that are listening that don't know the story, this was a window washing company. So it's like a couple $100s of cleaning supplies, some ladders, and then just knocking on doors. And we scaled that to 7 figures of recurring revenue, like within about just over a year. And so that was great. But most people's experience with entrepreneurship is much harder. Like, and it should be like it's an asymmetric game, but it's one of those games that if you play it well enough and you keep honing your skills, you will win it eventually. I got really, really fortunate that right out of the gate, I just landed in the right opportunity and it did really well. And then I got fortunate again because I made the right moves from that place. I took those skills and leveraged them into the next opportunity, into the next opportunity. And so I had a series of big wins that were just blind luck in the grand scheme of things. But you don't get lucky unless you put yourself in the right position to get lucky. And if there's anything that I did right at that point, it was making sure that I was positioned both from a skills perspective, a resources perspective, and then just the strategy that I was deploying, which was building businesses that did not require a lot of capital, that could scale very well, and then making sure that the as much of the success or failure of the company was going to be predicated on how hard we worked, which truthfully, it sucks because it means you have to work hard to win. But when that's the only thing that like really separates you from the other competitors in that field, and it's not like IQ, it's not your network and things like that are maybe more a little bit outside of your control. Like that was really, it was equalizing in a lot of ways. And it gave me a lot of confidence because it just meant like I knew I just had to wake up and go and like do the work. And so for people that are listening that are thinking like, oh, I want to do that too, like that sounds great, I want to be where you are, like start simple. Like I didn't start a business thinking I was going to change the world. I didn't chase my passion like as window washing. Like, I wasn't passionate about windows, but it was an easy way to learn the ins and outs of entrepreneurship, of business, and it was also potentially very lucrative. I would say start small and get those wins, and don't fixate so much on like the external validation, like of the money coming in. Like a lot of people think, oh, the reason you build a business is to get the money. And it's really not. Like it's not about having $1 million, it's about having the skills of the person who's capable of making $1 million. Because if you have the skills, then you can always deploy those regardless of where you are in life. If all you have is the $1 million, then you better guard it really carefully. And so focus on becoming the person capable of making money, capable of investing well, capable of building business as well. Focus on that, and everything else kind of will eventually, on a long enough time frame, take care of itself.
Yeah, I think that's a great message. And the few things I took away from there, as you said, you got lucky that it was sort of low margins, high margins, sort of low upfront costs, and it was scalable. Which I think whenever I'm thinking of, what do I want to do, those are key things, especially if you're a business that you're really looking to focus on. And
Mm-hmm.
and if it provides you with those skills, then that's perfect as well.
Yeah, and truthfully, I did not do that by intention. Like, I did not go and create like a matrix of opportunities and businesses and be like, which one should I pursue? It was a friend came to me and he's like, hey, let's build a window washing company. And I got really lucky. But with one of the really interesting things um, is in the last couple of years, I've had the opportunity to work with like a couple of other entrepreneurs in a coaching capacity. And one of them was this kid that I had coached in rock climbing. People that don't know my story, again, like I was a professional rock climber for like my mid 20s. And so I had the fortune of coaching this kid when he was like 14, 15 years old. And then he grew up, he went to college, and he came back around and he's like, hey, I want to build a business. And I was like, dude, you know what you should do? Landscaping. Landscaping is a great business model for college kids. Because again, low startup cost. You just go get a lawnmower, get a weed whacker, and then just go around knocking on doors. And sure enough, like he did that, him and a buddy. And then 2 years later, they would just do this during the summers. And 2 years later, like they sold that thing for a pretty little penny. And so I'm like, and he learned all the skills that you need to know, like as an entrepreneur, like how to build a product people want, how to put it in front of people to get them to pay, how to manage cash flows, like how to hire, how to fire, how to train, like all these things. And then you can take that knowledge and leverage it into the next opportunity. But it wasn't a sexy opportunity. I think a lot of people, what holds them back in the beginning and the reason they don't find success is because they're not willing to do the unsexy thing, and they want to go build like that really cool tech startup. They want to go do that really sexy thing. They want to start a fund and like go buy real estate, but they don't have the track record of the history or the relationships to do it. And so they don't get the success that they expect within a relatively small period of time, and they give up. And so for me, I'm like, get the easy wins and do the unsexy thing, because that's usually where the wins are.
Yeah, it's a great message. So, Anthony, thanks so much for joining the podcast. I really appreciate it. So, my last question is, what is one message you want people to take away from our conversation?
Well, going back to the real estate side of things, we talked a lot about the market kind of going doom and gloom on us, but the truth is that there's no such thing as a good or a bad market. There's merely the right or the wrong market given your skills, your resources, and your business plan. So where we're at in the market right now, your skills, your resources, the business plan you've been deploying over the last few years might not be the right one moving forward. So don't just put your head in the sand and say, oh, it's a bad market, I'm not going to buy anything. Look at it and say, okay, what about my skills needs to change? What about my resources, my network, my relationships has to change? What about my business plan has to change? Because there will be a lot of people who do very well during this next market cycle. And it could be you if you worked on those three things and you had them in alignment with what the market's giving us. So don't sit on the sidelines, get in the game, get active. It's the only way to get lucky.
Yeah, I like that. So, Anthony, thanks so much for joining the podcast. Appreciate it. So, we've mentioned your YouTube channel and your other podcasts. Where else could people find your work? Are those best places?
Yeah, those are great. Find us on YouTube, on Twitter. I hang out there a lot. You can find me at Anthony Vicino. I'm also on Instagram quite a lot. So that's the Anthony Vicino. Come hang out, shoot me a DM. I try to respond to all messages, which is a bit of a pain in the butt, but I love chatting with people. So if you guys got questions or stories you want to share with me, definitely hit me up and let me know.
Yeah, awesome. I'll put that all in the description below, but thanks again for your time.
Absolutely, man.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.